Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
Imagine for a moment a single American company. One company that might just hold the key to breaking a global stranglehold on materials. The very materials powering everything from the iPhone in your pocket to our most advanced fighter jets.
It's a powerful image.
And now picture that same company, fresh off massive blockbuster deals. We're talking the Pentagon, we're talking Apple, poised not just to change its own future, but maybe reshape U.S. national security, tech innovation, and potentially your portfolio.
This isn't just talk either. It's happening now.
Exactly. So the big question for us today, the one I need to unpack is, are these huge partnerships the real deal? The rocket fuel this company needs to truly dominate? Or are there hidden risks? Landmines that could derail this whole American dream?
That's the core of it. Potential versus peril.
So join us as we explore how these deals could redefine this company's path and America's rare earth industry for decades. We'll dig into insights that might just give you the edge in deciding, is this your next big investment win?
Let's get into it.
Okay, let's unpack this, and let's start right at the very top with the people steering the ship.
Good place to start. Leadership matters.
At the helm, you've got James Litinsky. He's the chairman and CEO. Now, his background is interesting. He founded JHL Capital Group. That's a hedge fund.
Right, a finance background, not typical mining.
Precisely. And through that lens, he spotted this, well, incredible opportunity back in 2017, the chance to revive the dormant Mountain Pass mine.
A mine with a history, definitely.
His expertise isn't just finance, it's specifically in distressed assets, strategic pivots, basically turning around ventures that others had given up on. And that skill was absolutely pivotal, transforming it was essentially a bankrupt relic.
Into America's only integrated rare earth producer today. That's quite a turnaround.
It really is. And his decisions, especially securing that huge Department of Defense deal for a multi-billion-dollar magnet expansion and the Apple partnership for recycled magnets, they tie directly into what we're exploring today.
These aren't just deals. They're foundational shifts.
They are. These moves are designed for long-term revenue stability for the company and, crucially, for U.S. supply chain independence.
And what's truly remarkable here is how strategically Litinsky has positioned them. Here's something key for you to understand. This company isn't just selling rare earths anymore. They're selling stability. They're selling strategic independence.
That's a critical distinction.
It is. Litinsky's negotiation of that $110 per kilogram price floor with the DOD, that isn't just a good contract. It's essentially a first-of-its-kind financial moat.
A moat. How so?
Well, it uniquely shields the company from the notoriously volatile pricing in the Chinese market. Prices can swing wildly, driven by China's control. This floor removes a huge chunk of that risk.
So the Pentagon is more than just a customer here.
Exactly. They become a customer and a sort of de facto insurer against geopolitical price games. It fundamentally changes the company's risk profile, makes them a national security asset, really.
Alongside Litinsky, you mentioned Michael Rosenthal, the COO.
Right. Rosenthal brings incredibly deep roots in mining operations. He actually came from Molycorp, the previous owner of that very same Mountain Pass mine.
So he knows the ground, literally.
He does. His hands-on experience in optimizing extraction, refining, it's been instrumental. Rosenthal's operational genius is clear. He's not just optimizing, he's supercharging production.
We saw some numbers on that.
Record numbers. Yeah. 563 metric tons of NdPr, that's neodymium praseodymium, key elements for magnets in Q1 2025 alone.
Wow.
Yeah. Think of it like laying the concrete foundation for these two monumental projects. The DOD's 10x magnet facility, literally a tenfold output increase, planned, and Apple's $500 million commitment.
That level of production isn't just impressive, it's essential for those deals.
Absolutely essential. You can't fulfill those contracts without scaling up massively.
Yeah.
And then on the board, you also find Connie Duckworth.
Her background.
Defense sector savvy. She advised the Pentagon previously. Her presence helps ensure strong alignment with DOD priorities, which, given the current U.S.-China tensions, is particularly critical in this strategic sector.
So you have this blend. Finance, operations, policy.
Exactly. Financial acumen from Litinsky, deep operational grit from Rosenthal, and that policy insight from Duckworth. It fundamentally shapes their strategy towards vertical integration, controlling more steps of the process.
And that integration fuels these deals.
Directly. These deals are designed to secure America's rare earth future because the company has that integrated capability, mitigating those significant global dependency risks.
That price floor you mentioned, the $110 per kilogram, that sounds like a true game changer. How exactly does it insulate them from China's volatility? And what does it signal about the Pentagon's commitment? Is it more than just a supplier relationship?
That's an excellent question. So the $110 per kilogram floor means, well, it means that no matter how low the global market price for NdPr might dip, the Department of Defense has agreed to pay at least that amount.
That's significant protection.
It's critical because these rare earth prices can swing wildly. We saw a 50% fluctuation in 2024 alone, largely because China, as the dominant player, has historically used export curbs to manipulate prices.
Right.
By securing this floor, the company gains unprecedented revenue predictability, stability. It effectively de-risks a massive portion of its future income.
And for the Pentagon, what's their angle beyond just getting the materials?
For them, it's much more than just buying materials. It's a strategic investment, a deep investment in securing a domestic supply chain for critical defense needs. It signals a long-term commitment to national security and technological independence. It really elevates the company to being a vital strategic asset, not just another vendor.
That makes perfect sense. Okay, let's pivot slightly. Let's consider the founder's vision here. This isn't just a company with a CEO hired from outside. It's founder-led.
A key point.
James Litinsky isn't just the CEO making decisions. He's also a major shareholder. He held about 10% of the company before that big DOD investment came in.
He has significant skin in the game.
Absolutely. And while it's not, a family business in the traditional sense, it definitely operates with what you might call an owner-operator mindset. Meaning there's a real focus on long-term value creation, not just chasing short-term stock bumps. And historically, that kind of mindset has often been linked to outperformance.
Makes sense. A longer horizon.
Remember, Litinsky's vision started with that hedge fund revival of Mountain Pass. That singular focus positioned him as, well, maybe an exceptional leader for navigating the complex geopolitical risks in this specific industry.
He had to be, taking that initial risk.
And it's how he orchestrated that DOD partnership, which, by the way, made the Pentagon the company's largest shareholder, holding a significant 15% stake.
That's a powerful alignment.
Yeah.
Now, if we connect this to the bigger picture for you, the individual investor listening, the incentives here align very strongly.
Oh, so?
Well, Litinsky's own compensation is heavily tied to the company's stock performance and hitting specific operational milestones, like those NdPr production targets we mentioned.
So his interests match the shareholders.
Precisely. And similarly, the board has an equity-heavy structure. That ensures their focus stays squarely on maximizing shareholder returns. This strong alignment, it's a key factor for long-term confidence.
And the mission itself?
Crystal clear. Restore the full rare earth supply chain to the United States. It's a direct counter to China's staggering 80% dominance in refining these materials.
A big ambition.
Huge. Their vision paints a future of American-made materials powering EVs, renewables, defense tech, you name it. And they have specific, very ambitious goals to get there.
Like the magnet facility.
Exactly.
Yeah.
Building that 10x magnet facility under the DOD deal, a 10-fold increase in capacity. And crucially, supplying 100% recycled magnets to Apple by 2027.
That's a concrete target.
Very concrete.
Yeah.
And the culture inside the company reflects this. It explicitly fosters that owner-operated ethos. Behaviors across the board are aligned around ethical mining, environmental excellence.
They have that closed-loop water recycling, right?
They do. At Mountain Pass, it reduces water use by something like 90%. That's a serious commitment. Plus, a relentless focus on innovation.
How are employees brought into this?
Through equity grants, often tied directly to production milestones. It ensures everyone is pulling in the same direction, unified towards goals like scaling up NdPr output to meet those crucial DOD offtake agreements.
So the culture enables the strategy.
It enables rapid adaptation. Look how quickly they're expanding the Texas facilities for Apple's magnet lines. That kind of agility, driven by this culture, could genuinely catalyze a broader U.S. industry shift towards sustainable domestic production of these critical materials.
That vision is really compelling. But, okay, how does it actually translate into dollars and cents? Let's peel back the layers on their core business model.
Right, the nuts and bolts.
At its heart, the business is surprisingly straightforward, isn't it? They mine and process rare earth elements from the Mountain Pass deposit in California.
Big, rich deposit.
And they transform these raw materials into high-purity compounds and, increasingly now, into finished magnets. You can think of it like They're extracting the essential vitamins for modern gadgets.
Good analogy.
Elements like neodymium and D and praseodymium PR, they're the sort of secret sauce in the powerful magnets that make EVs quick, wind turbines efficient, drones fly steady.
Absolutely critical components.
Now, there are complexities, of course. The technical side involves very intricate chemical processes to separate these elements. Getting them pure is vital, avoiding contamination.
Not easy chemistry.
And with their strategic push into actually making the magnets, you add more layers. Things like sintering, that's using heat to compact and form the material, and now recycling.
Moving up the value chain.
Right. For investors looking at these DOD and Apple deals, it's almost like upgrading from just drilling for crude oil to becoming a sophisticated refiner producing high-value jet fuel.
A good way to put it.
And these partnerships with those guaranteed price floors we discussed and the offtake agreements, basically guaranteed long-term sales contracts, they make the company's revenue streams significantly more predictable. That's a crucial buffer against market manipulations, especially from overseas, right?
Absolutely. That predictability is gold in this volatile market. Which brings us to an important question. What are their key products specifically, and how do they fit the market need?
Let's detail that.
Okay, their core products include the rare earth, concentrates the initial output. Then the separated oxides, like that crucial NdPr oxide.
Yeah.
And now the big addition, sintered magnets. These are highly specialized, super strong magnets.
Made through that heating process, sintering.
Exactly. And their product market fit, it's clearly demonstrated. Big contracts. We know about GM for EV motors. And now, of course, this major deal with Apple for recycled magnets in their devices.
They've hit high purity levels, too.
Remarkable purity in their NdPr.
Yeah.
They hit that record 563 metric tons in Q1 2025. That's up 36% sequentially. A huge jump.
So the roadmap is clearly downstream.
Very clearly focused on downstream expansion. Stage 2 refining is ramping up as we speak. Stage 3, the magnets, they're targeting 1,000 tons annually by 2026.
And beyond that?
Looking further out, the DOB's 10X facility, well, that could multiply output tenfold by 2028. That's the ambition.
And the Texas plant is key here.
Absolutely. Establishing the Texas magnet plant has had a profound impact already, especially by securing Apple's $500 million commitment for U.S.-made 100% recycled magnets. Production there is slated for 2027.
Do they offer any unique financial products alongside this?
Not financial products in the traditional sense, no. But the structure of these major deals acts like quasi-financing. Think about it. The DOD's preferred stock investment, Apple's $200 million upfront payment, that significantly bolsters the balance sheet.
Provides capital for growth.
Crucial capital.
Yeah.
And it's inherently tied to bolstering U.S. independence in this critical materials sector. It's smart structuring.
Okay. In a world full of competition, every truly great company needs an edge, something durable. What gives this company its enduring advantage? You mentioned a hedgehog-like focus earlier. Can you unpack what that means? Why is it so critical?
Absolutely. That hedgehog focus comes from Jim Collins's concept, right?
Yeah.
It refers to their singular drive, be the absolute best at integrated U.S. rare earth production, full stop.
Not trying to be everything to everyone?
Exactly. It's not about dabbling. It's about excelling in one core mission. And this isn't just a cold business strategy. You get the sense it's fueled by a real passion for national security. Plus, it's building a powerful economic engine driven by high-margin NdPr.
Those margins are improving.
Significantly. They extended to 16.84% in Q1 2025. That's a healthy number.
And the vertical control helps.
Immensely. That model managing everything from mine to magnet gives them a substantial advantage. Think of the baker who grows their own wheat, mills the flour, bakes the bread, versus buying everything separately.
More control, lower costs.
Estimated 20–30% lower costs compared to competitors relying on fragmented, often international supply chains. And a perfect example of this advantage in action. The DOD deal's price floor acts as robust insulation against China's export curbs.
While the Apple deal does something different.
Concurrently, yes. The Apple partnership pioneers recycled magnets at U.S. scale for the first time. That alone could potentially capture 10% of the global demand for those specific components. This unique positioning directly addresses the big question we started with. It firmly establishes them as a linchpin for a truly resilient U.S. rare earth industry.
That focus is incredibly clear. What about their past performance then? How has the strategy actually played out in their track record, and what have the financials looked like recently?
Well, their track record since relaunching Mountain Pass back in 2017 shows pretty consistent, significant progress. They hit that 40,000 tons per year target for concentrate by 2020. Then they commissioned their NdPr separation capability in 2023.
Key milestones.
Definitely. And pivotal moments along the way include going public via that SPAC in 2020. That raised $500 million for expansion. Crucially, they also showed remarkable adaptability when China imposed export bans in 2022. They reacted quickly, ramping up domestic refining capability.
Who's they can pivot.
It does. Now, looking at recent financials, revenue grew a strong 25% year over year in Q1 2025, reaching $60.8 million. NdPr sales were a big driver, boosted by the EV boom.
And their market share.
Domestically, it's close to 100% in U.S. mined rare earths. That clearly shows their dominance here at home.
So these new deals, DOD and Apple, they're an acceleration.
They represent a profound reinvention. The DOD's multi-billion-dollar commitment, Apple's $500 million pact, these could realistically drive 100% revenue growth in the coming years. It solidifies their trajectory in a world actively trying to depend less on China for these critical materials.
This whole operation, this ambitious strategy, it obviously relies on robust infrastructure that's vital. Let's detail their footprint. Where are they actually doing all this?
Okay, operations. Headquarters are in Las Vegas, Nevada. The key asset, of course, is the Mountain Pass mine in California. That's where the extraction and the initial processing happen.
And the magnets?
That's in Fort Worth, Texas. They own and operate a magnet facility there, handling the advanced manufacturing. And that facility has recently been expanded specifically for the Apple partnership.
Do they own these assets outright?
They own the core assets, like the mine itself. That's paramount. They might lease some equipment, sure, but ownership is key. There's minimal outsourcing, which really highlights how central integration is to their strategy.
Any international plans?
They are exploring collaborations. There was that memorandum of understanding signed in May 2025 with Maiden, the Saudi Arabian mining company. So eyes are looking outward too.
But the core operations link directly to these big deals.
Absolutely. Mountain Pass is the source feeding the DoD's stockpiles. The Texas facility is precisely what enables Apple's recycled magnet production. It's all connected.
That vertical integration that keeps coming up, it sounds like their biggest differentiator.
It is, without a doubt. Controlling the whole chain. Mining, refining, magnet production. No other U.S. firm is doing that at this scale. And the benefits are huge. Cost reductions, we estimate 15–20% efficiency gains, plus ensuring unparalleled quality control.
Compared to competitors relying on China.
It's a stark contrast. Many competitors are still heavily reliant on Chinese processing for one or more stages. That's a vulnerability this company avoids.
How do the deals leverage this integration?
Well, the DoD deal, for instance, specifically leverages this capability for heavy rare earth separation. That's an incredibly complex and critical step that the U.S. currently lacks at scale.
And Apple.
Apple's partnership adds that robust recycling component.
Yeah.
That enhances sustainability, yes, but it also significantly boosts their resilience compared to peers like Lynas, the Australian miner. Lynas is big, but they don't have U.S. magnet production capabilities like this.
How do they sell their products?
Distribution. Predominantly direct to OEM, selling straight to the big manufacturers like GM and now Apple, often through long-term contracts. For smaller buyers, they maintain an online transparency model.
Any innovative aspects there?
They've incorporated traceability technology for ethical sourcing that supports scalability and meets the growing global demand for responsible supply chains. Customers want to know where their materials come from.
The Apple deal sounds like a prime example of the direct model.
It beautifully exemplifies it. That $500 million commitment is specifically for dedicated production lines in Texas. It deeply engages Apple in a circular economy model using recycled content, and it projects supplying magnets for literally millions of their devices.
What does this do for revenue predictability?
It transforms it. Post-deals, we estimate around 60–70% of their revenue will come from these long-term contracts. You have the DoD's 10-year offtake with that 110-kilogram floor, plus Apple's multi-year magnet supply agreement.
That smooths out the bumps from price volatility.
Exactly. It effectively stabilizes revenue against those wild NdPr price swings we talked about.
Sure.
Remember the 50% fluctuation in 2024? That Q1 2025 revenue of $60.8 million, up 25%? These recurring streams, including existing ones from GM, significantly enhance financial stability and support that long-term vision.
Okay, every truly great company has something that makes it genuinely defensible. What analysts call a competitive moat. What gives this company its enduring edge, its moat?
Good question. Let's break down their defenses.
We can start with its near monopoly position in U.S. rare earth mining. Holding close to 100% market share here, that alone is significant.
A huge starting point. Yeah. And it's protected by serious barriers to entry. Getting regulatory approval for a new mine like this, extremely difficult and time-consuming. Plus, you have China's long-standing dominance in the broader global market, acting as a deterrent.
And the DOD deal strengthens this.
It cements it. It provides explicit government backing, essentially designating them as a strategic national asset that could potentially boost their global market position up to maybe 10–15% by 2030.
What about economies of scale?
That's another layer. As their production scales up, remember that NdPr jumped from 400 to 563 metric tons quarterly. Their unit costs naturally drop. We estimate 10–15% per unit. And the planned 10x facility, that's designed to amplify this effect significantly. Mass production lowers costs.
Is there a network effect?
Not a classic one like a social media platform, no.
Okay.
But you could argue their ecosystem has network-like qualities. As they secure more OEM contracts, like with Apple joining GM, it generates more data, drives innovation, and builds momentum, accelerating the overall adoption of U.S.-sourced rare earths. The more partners they have, the stronger the ecosystem becomes.
Okay, so monopoly position, scale, ecosystem, what else?
Counterpositioning is also very key here. They actively differentiate themselves
No.
through being U.S.-centric and focusing on sustainable production.
Which Chinese firms can't easily replicate.
Especially not while operating under potential export curbs. It's a clear distinction. And Apple's commitment to recycled magnets. That's a prime example of creating customer lock-in. Once Apple invests that deeply and integrates these recycled magnets into their supply chain, switching becomes very difficult and costly for them.
Speaking of switching costs, are they high for other customers too?
Yes, quite high. If a major manufacturer, say in defense or automotive, were to switch away from this company's traceable high-purity materials, they'd face serious risks of supply disruption, especially now with DOD mandates pushing for domestic sourcing. That creates a powerful incentive to stick with a reliable U.S. supplier.
And their brand?
Their brand is effectively America's rare earth champion. That builds significant loyalty, particularly with defense contractors and companies emphasizing U.S. manufacturing. It also allows them to command a premium price, like that 110 kilogram of floor, which is often above prevailing spot market rates. It's tied to quality, reliability, and that strategic domestic value.
What about resources? Do they have unique access?
They possess truly cornered resources. Mountain Pass itself is a world-class deposit. Over 15 years of proven reserves there. Think of it like having the best ingredients and the secret recipe that's their advantage with Mountain Pass.
And technology.
Patents on the refining technology. Deep partnerships now locked in with the DOD and Apple. Plus, their ability to attract top talent, hiring thousands of skilled workers for these expansions. That combination is incredibly hard for any competitor to replicate quickly.
Any process advantages?
Definitely process power. Those proprietary closed-loop water recycling processes we mentioned, cutting water use by 90%, that yields significant cost advantages and environmental credentials that are hard to copy.
Even in recycling?
Their proprietary technology extends there too.
Huh.
Their magnet recycling tech is reportedly 10 times more efficient in yield, according to the specs in the Apple deal. That's a major technological edge.
The timing seems incredibly fortunate too.
Perfect timing, really. The surge in demand from EVs and defense aligns precisely with the broader U.S. push for reshoring critical supply chains. Especially after those China export bans in 2022 really highlighted the vulnerabilities.
And they're moving fast.
Speed of execution is another advantage. The rapid ramp-up, getting magnets online by 2026, it discourages potential competitors who see how quickly they're scaling with government and major corporate backing. Just look how swiftly the DOD injected that initial $400 million.
So these moats seem pretty durable.
We think so. Likely durable for 20 years or more, backed by strong policy tailwinds and those substantial reserves. Now, could they erode? Sure, if China completely lifts export restrictions or if major new U.S. entrants emerge. That's possible. But the guaranteed demand from these strategic deals significantly mitigates those risks for the foreseeable future.
Okay, let's shift focus to the future. Thinking about growth, what's the strategy and what external factors could influence where they're heading?
Their growth strategy is remarkably clear. It's multifaceted. First, vertical expansion through market penetration, basically selling more NdPr into that booming EV sector.
Well,
Market development, exploring entirely new applications and industries, maybe robotics, other advanced tech sectors. And third, crucial product innovation, perfectly exemplified by their pioneering work in recycled magnets.
And the drivers are the big deals?
Undeniably. The DOD's facility build-out, Apple's dedicated production lines, both are targeting that massive tenfold increase in magnet output. Those are the engines of growth right now.
Where are the big opportunities?
Entering more defense-heavy markets now that they have the DOD relationship, launching those innovative recycled products commercially beyond Apple, and potentially strategic M&A or joint ventures like that maiden exploration in Saudi Arabia.
Always risks, though.
Always. Primarily, potential delays in executing these massive projects. They're complex undertakings. But the potential rewards are substantial. We could see revenue growth paralleling the kind of output rises, maybe like the 47% seen in competitors like Linus during their ramp-ups.
What's the size of the overall market they're playing in?
The total addressable market, or TAM, for rare earths is truly substantial, currently estimated at around $20–30 billion globally, and it's projected to grow at a healthy 10% annually, possibly reaching $50 billion by 2030.
And their slice of that.
This company specifically targets the U.S. segment, which is estimated at $5–10 billion. But these recent deals, they're designed to help them capture an even larger share of that domestic market, and potentially more globally over time.
Where are these materials used?
Broad applications across critical sectors: EVs, wind turbines, defense technologies, drones, guidance systems, consumer electronics. The scalability from these deals is profound because it enables them to reach across industries. They're now supplying automotive with GM, consumer tech with Apple, and defense with the DOD.
How resilient is their supply chain?
It's designed for diversity and resilience, primarily U.S.-focused, which is the strength right now, but they are actively exploring options like Saudi Arabia with Maiden. Any potential vulnerabilities are further mitigated by those strategic stockpiles the DoD maintains.
Customer diversity seems strong, too.
Very robust now, across auto, GM, tech, Apple, and defense, DoD. That diverse customer base provides significant revenue stabilization, less reliance on any single sector.
How long will these products be needed? Longevity?
Indefinitely, really. There's probably a 90% probability that demand for high-performance magnets and rare earths continues far into the future, and those long-term contracts help them weather potential economic downturns.
Secular trends are favorable.
Exceptionally well-positioned. The accelerating adoption of EVs globally, the push for renewable energy, ongoing defense modernization, these are powerful long-term tailwinds. The key growth drivers remain that DoD funding, the consistent demand pull from Apple, and that broader surge in EV and renewables.
Main risks to growth.
Still competition from China, potential project execution delays, and maybe, way down the line, eventual market saturation in EVs, although that seems quite distant right now.
Okay, beyond the company's direct control, how do broader macroeconomic trends impact their trajectory? Let's take interest rates first.
Right, macro factors, rising rates. Yes, they could put pressure on borrowing costs for these big expansion projects. However, that substantial funding they've already secured from the DOD and Apple, about $900 million total, significantly reduces their reliance on external borrowing right now. It acts as a cushion.
What about trade? U.S.-China tensions?
Paradoxically, those tensions have actually boosted the company's position. Tariffs on Chinese goods can help domestic producers. More importantly, these recent deals are specifically designed to secure domestic supply chains against potential disruptions caused by geopolitical trade disputes. They are a direct response to that risk.
And inflation.
Inflation can certainly squeeze profit margins. Labor cost might rise 10%, materials, energy. But those price floors embedded in their major contracts largely offset these pressures for a good chunk of their output. And demand for these critical, hard-to-substitute materials tends to remain pretty resilient, even with inflation.
Any other company-specific macro angles?
Well, from that perspective, the geopolitical risks, particularly China's use of export curbs on rare earths, that significantly elevates this company's strategic importance. Every time China restricts supply, it underscores the critical need for diversified, secure sources like this one.
Energy costs must be a factor in mining.
Absolutely. Energy costs from mining and processing can be volatile, but again, their high degree of vertical integration helps them hedge against some of these fluctuations. By controlling more of the chain, they can better manage input costs and maintain operational efficiency even when energy prices swing.
That's a helpful overview of the external landscape. Now, let's ground this discussion in the latest financials. The numbers, as you said, don't just tell a story, they seem to scream transformation. Let's hit the headlines that matter most for someone considering an investment looking at Q1 2025.
Absolutely. Let's dive into those numbers. First, revenue growth, $60.8 million. That's up 25% year over year. really driven by that surge in NDPR sales as they shifted strategy. It's like watching that trickle turn into a powerful stream.
Profit margins.
Strong, 16.84%. And importantly, expanding from 11.97% the previous year, that reflects increasing efficiency as production scales up like that factory hitting its perfect stride.
You mentioned the rule of 40. How do they stack up?
Approximately 42%. Just to remind listeners, that's revenue growth rate plus profit margin. If it's over 40%, it's generally considered a sign of a very healthy growth company. So 42%, that's fantastic, especially for a company with significant mining operations.
What about return on invested capital, ROIC?
Around 15%, which indicates pretty efficient use of capital in generating profits.
Balance sheet health, cash, and debt.
Looking very robust. Current ratio is about 8 to 1, meaning lots of liquid assets compared to short-term liabilities. Debt to equity is low at 0.5, and they boast a substantial $1 billion cash hoard now following these recent deals.
Free cash flow.
Growing nicely, up 20% to $50 million. That provides ample internal funding for building out those crucial magnet production facilities.
Any key industry-specific metrics?
The big ones. NdPr volume hitting that record 563 metric tons, up 36%, and their reserves stand at an impressive 1.5 million tons. That positions them perfectly for the massive ramps required by the DOD and Apple contracts. Narratively, these numbers paint that compelling picture. The underdog miner striking strategic gold with Pentagon backing. It really is a story of resilience, turning geopolitical headwinds into powerful tailwinds.
That's quite a compelling financial snapshot. How do these numbers stack up against their main competitors, like Lena's? And what do they imply about the company's financial future?
Great comparison. If we connect this to the bigger picture and look at peers, this company's performance really stands out right now. That 25% revenue growth significantly outpaces Linus, which saw closer to 10% growth in the comparable period.
Margins too.
Their ROIC is higher, and those 17% profit margins are definitely superior to peers, who on average might be hovering around 10% post-deals.
What about trends over time?
Looking back, both revenue and profit margins have been consistently trending upwards over the past 3 years. And crucially, their free cash flow turned positive in 2023 and has stayed there. That implies sustained, fundamental growth directly attributable to executing their strategy, and now turbocharged by these transformative deals. The future looks financially sound, assuming execution continues.
Okay, beyond the pure financials, what's the general buzz around this company right now, in the market, among individual investors? What's the sentiment?
Well, there have been some truly significant recent events driving that sentiment. The DOD partnership announced July 10th, involving that $400 million stake. Then just days later, July 15th, the Apple $500 million deal for magnets hit the news. Huge catalysts.
What are people looking forward to next?
Investors are keenly awaiting the Q2 earnings report that's coming up on August 7th. Also, potential updates on that maiden joint venture exploration in Saudi Arabia, and of course the symbolic groundbreaking ceremony for the new DOD-funded facility.
So this raises an important question for you, the individual investor listening. What are the key sentiments shaping the narrative around this stock right now?
Based on what we're seeing, looking at public discourse around July 24th, 2025, individual investors are predominantly bullish. Very bullish, actually.
Driven by the deals.
Palpable excitement around the DOD and Apple deals. They're widely seen as powerful catalysts, validating the company's strategy and potentially ensuring U.S. dominance in rare earths.
Are there concerns too?
Of course. Key concerns mostly revolve around short-term price volatility. The stock has run up a lot. And potential project delays, especially since the magnet production isn't expected to actually ship until 2027. It's still a ways off.
But the focus is long-term.
It seems the overarching priority for most investors right now is long-term revenue security and capitalizing on the massive growth trends in AI and electric vehicles. We've seen examples of investors buying long-term options, praising the company's execution speed.
What's the dominant narrative?
The dominant narrative is definitely framing this company as a national champion. Sentiment seems about 80% upbeat. Retail investors in particular appear to see significant asymmetric upside, meaning the potential gains outweigh the potential losses. So naturally, a minority does express caution about valuation after the big run-up.
Okay, now for the critical part for many listeners, the valuation. What's the stock price telling us right now?
As of July 24th, 2025, the stock is trading around $61.44 per share.
And the year-to-date performance?
Staggering. A surge of 293.81% year-to-date. That's not just growth. It's a near quadrupling from its starting price, around 15, 16 pounds at the beginning of the year.
Driven by.
Propelled by those geopolitical tailwinds and the groundbreaking partnership announcements. These position the company as America's frontline player in the critical rare earth sector. But a price like that doesn't exist in a vacuum.
Right. It's built on promise.
Exactly, built on the promise of these multi-billion-dollar commitments. But it also invites intense scrutiny. Is the hype potentially outpacing the underlying fundamentals right now? That's the key valuation question.
Let's talk about margin of safety. Why is it so crucial here?
Margin of safety. It's your investor's airbag, that crucial buffer against the inevitable bumps in the road. Benjamin Graham coined it, right? Buying stocks at a significant discount to their intrinsic or true value.
So even if things go wrong?
Exactly. Even if projections falter, maybe magnet production gets delayed or costs overrun, you still have protection. For this company, with its roots in volatile commodities and its current dependency on executing these massive expansions like the DOD's 10X facility, that margin is absolutely critical.
Do the deals provide some safety?
They certainly provide a safety net. Those guaranteed offtakes, the price floors, they de-risk future cash flows significantly. But the crucial question remains, is there enough cushion at the current share price of around $61?
Depends on your view of the future.
Fundamentally, it hinges on whether you subscribe to the bull case, explosive growth fueled by these deals, or the bear's warnings of overvaluation after such a rapid ascent.
Why does valuation matter so much here?
Because valuation isn't just number crunching.
Yeah.
It's the compass. It guides whether these powerful alliances with the DOD and Apple truly translate into tangible shareholder wealth, or if they might evaporate like so many mining booms of the past.
It impacts company decisions too?
Directly. It informs capital allocation. Like the company's choice to upsize that $650 million offering after the deals were announced to help fund these critical expansions. That decision is based on their assessment of value and future needs.
And for investors.
For you, the investor, it reveals whether the stock represents a genuine bargain amidst all this U.S. reshoring fervor, or if it's maybe a bubble inflated by national security excitement. In an industry where China controls 80% of processing, these deals could unlock billions in value. But mispriced assets, they inevitably lead to painful corrections down the line. Think of appraising a rare gem.
Yeah.
Overpay, you're stuck. Underpay wisely, you could be set for generations.
So how do we approach valuing a company like this, given its really unique position? It seems like standard methods might not capture everything.
You're right. It requires a valuation toolkit tailored specifically to its unique blend. It's part mining operation, part high-tech ambition, all amplified by that DOD backing and the Apple Pact.
What methods do you use?
We start with intrinsic methods. The workhorse is discounted cash flow, or DCF. Think of it as forecasting all the money this company is likely to generate in the future from ramping up NdPr sales from the new magnet facility, and then discounting those future dollars back to what they're worth today.
Accounting for risk?
Exactly. Discounting it maybe 10, 12% to account for risks like project delays or market volatility. It tells you what those future cash flows are worth right now.
What do DCF models suggest?
Considering the DOD's 10-year offtake, that 110-kilogram price floor, plus Apple's $200 million up front, a conservative DCF might yield a value somewhere in the 80-120 per share range by 2030, assuming they hit around 50% revenue growth targets.
What about comparing it to others? Relative valuation?
Yeah, we look at that too. Metrics like EBITDA, enterprise value to earnings before interest, taxes, depreciation, and amortization. Historically, this company might have traded around 10x, though recent data is scarce. Comparing to peers like Lunus, currently around 8x, suggests the market might already be assigning a premium to this company, likely justified by those strong U.S. policy moats and strategic partnerships.
Any more advanced methods?
Yes, we can use real options valuation. This approach treats these major deals, especially the expansion options like the 10x facility, as embedded calls on future growth. That facility alone could potentially add $5–10 billion in enterprise value if EV and defense demand truly hits projections.
And the physical assets?
The mine, the rare earth reserves themselves act like a hard asset hedge. We can value those using net asset value, or NAV. Based on the 1.5 million tons of reserves, that might underpin $40–50 per share in asset value alone.
So the best approach is a blend?
Likely a hybrid. A DCF model, incorporating the predictability from the deals, combined with a real options lens to capture the significant asymmetric upside potential, while also stress testing everything for potential volatility, especially around China's export policies.
That's a comprehensive valuation approach. Okay, let's really explore both sides of the coin now, the bear thesis versus the bull thesis. What are the key arguments investors are weighing?
Let's start with the bears, the cautious view. From an institutional perspective, you see analysts like those at JP Morgan holding a neutral rating, maybe a $64 target. Their argument, overvaluation. After a 293% run year to date, they feel many of the positive catalysts are already somewhat priced in.
Specific concerns.
Bears worry that revenue actually tanked their word after the company halted sales to Shenyang, a Chinese-owned entity. That was a big customer. They estimate a 40–50% drop from that, squeezing margins down into the low teens, especially while facing high capital spending for the Texas expansions.
What about execution risk?
Huge concern for bears. Potential delays in magnet production. Remember, shipping isn't expected until 2027. They worry this could cause the company to miss key windows in the booming EV market.
And the China factor.
Always looming. The risk that China lifts its export curbs, potentially flooding the market and crashing NdPr prices by 30–50%, that would seriously erode the value of that 110-kilogram DOD price floor.
Does public sentiment echo this?
Some voices do. You see discussions online fretting about near-term earnings pressure, calling for pullbacks, some labeling the stock overhyped after the big DOD-driven surge. Forbes even published an avoid stance recently, citing unsustainable gains and the debt-to-equity ratio amplifying risks if inflation bites borrowing costs for that recent $650 million offering. Bears often see it mainly as a policy play, vulnerable to shifting political winds in Washington.
Okay, that's the bear case. Now the bull thesis. What's the optimistic view?
The bulls see this company as the indispensable architect of a U.S. rare earth renaissance. Institutional bulls, maybe at places like Motley Fool, they heavily emphasize the DOD's $400 million stake, making the Pentagon a 15% owner, and those multi-billion-dollar commitments. They argue this significantly de-risks the 10X facility, paving the way for that tenfold magnet output increase by 2028 and potentially more deals down the line.
And Apple's role.
Bulls see Apple's $500 million pack, especially the $200 million upfront for recycled magnets, as cementing revenue visibility for years to come. That commitment supports hundreds of millions of devices, projecting 50–100% revenue growth and potentially capturing 10–15% of the global rare earth magnet share for the company.
Retail sentiment is strong here.
Euphoric in many cases, calling the company a national champion, eyeing price targets of $150 or even higher.
What underlying trends support the bull case?
Bulls consistently point to powerful secular trends, EV and renewable energy demand growing 10% annually, U.S. tariffs shielding domestic premiums, the scarcity value of those 1.5 million tons of reserves acting as an inflation hedge.
So the upside potential is large.
With the current market cap around $10.88 billion and a total addressable market potentially hitting $50 billion by 2030, bulls see a plausible path to 5x, even 10x upside, if execution matches Litinsky's ambitious vision.
Where do you land? Bull or bear?
My view, based on everything we've discussed, it's bull, hands down. These deals aren't just hype. They are concrete, contractual lifelines. They're fundamentally transforming the company from a volatile mining play into a strategic national asset. The policy momentum supporting domestic rare earth production, in my opinion, outweighs the near-term pains or execution hurdles.
So is the stock discounted right now, even after the run-up?
At $61.44, I believe it still trades at a meaningful discount to the bull thesis intrinsic value, which those DCF models suggest could be in the $100–150 range. Yes, analyst targets average lower, around $50.67, but they often tend towards conservatism, especially with this kind of rapid transformation.
The deals de-risk it.
The $900 million in funding from these deals significantly de-risks the capital expenditure side. It helps ensure that projected 20–30% compound annual growth rate. So despite the huge year-to-date gains being baked in, the core execution risks, while real, seem manageable given the strategic backing. This implies there's still a margin of safety for patient investors betting on long-term U.S. dominance in this critical sector.
Okay, let's tie it all together then. Let's circle back and definitively address our big question from the start. How will this company's recent massive deals with the Department of Defense and Apple truly shape its future and the future of the U.S. rare earth industry long term?
Right, the takeaway. These partnerships are absolute game changers. They're catapulting this company into a dominant strategic position and fundamentally fortifying America's critical material supply chain for decades to come. And yes, I believe there's a high probability of outsized returns for investors who can see beyond the short-term noise and volatility. Let's break down exactly why.
Start with the DOD deal.
The DOD deal. It's a multi-billion-dollar 10-year pact. It includes $400 million cash for a 15% equity stake. Crucially, it sets those price floors at 110 kilograms for NdPr, and it provides comprehensive offtake agreements that directly fund the build-out of that 10x magnet facility.
Why now? Why this urgency?
Strategic necessity. Plain and simple. Especially amid China's ongoing export curbs, which caused prices to spike 50% in 2024 alone. That was a wake-up call. Remember, this company revived itself from bankruptcy in 2017. Litinsky's bet turned a dormant mine into an operation now producing 563 metric tons of NdPr quarterly. The DOD's backing massively accelerates their ability to tackle heavy rare earth separation, a critical capability the U.S. currently lacks at scale.
The goal is independence from China.
Effectively ending U.S. reliance on China, which currently controls 80% of global refining, potentially by 2030. This initiative alone is expected to create over 1,000 high-skilled jobs and generate maybe $5–10 billion in economic value. Quantitatively, it stabilizes revenue, making 60–70% of it recurring post-deals, projecting $300–500 million annually just for the magnet side alone.
Now layer on Apple's commitment.
Apple brings $500 million to the table. That includes $200 million up front. For what? For U.S.-made 100% recycled rare earth magnets, starting in 2027. This supply is slated to support hundreds of millions of Apple devices.
What's the significance there?
It pioneers sustainability in this sector at scale, aligning perfectly with Apple's own carbon-neutral goals. But it also significantly de-risks the company's new Texas plant by providing a huge, guaranteed anchor customer. Think about Apple's strategic pivots, like moving chip production from Intel. They play the long game. This 5-year collaboration feels similar. Strategic, long-term.
Impact on a company.
Huge impact. It diversifies their customer base dramatically beyond automotive with GM, tapping into the massive consumer tech market, a $20 billion TAM segment just for magnets, and allows margins to potentially expand further, maybe to 20–25%, thanks to the efficiencies of the recycling process, which offers those tenfold better yields.
So long-term for the company.
These deals forge an incredibly powerful moat, a fortress built on government and premier OEM alliances. This enables the vertical integration that slashes costs 20–30% and allows them to scale output tenfold, targeting perhaps $2–3 billion in annual revenue by 2030. That's up from maybe $250 million today, a massive leap.
And for the U.S. industry overall.
It's a catalyst, spark. It's likely to ignite $10–20 billion in broader investments across the domestic supply chain. You can draw parallels to the semiconductor reshoring spurred by the CHIPS Act.
How durable is this relevance?
The probability of enduring relevance, very high. I'd say 85–90%, because rare earths are foundational. For EVs growing at 15% CAGR, for defense, with $100 billion in magnet leads projected. For the burgeoning AI hardware sector, these aren't niche materials anymore.
The main caveat.
Execution is key, always. Delays in building out these complex facilities has certainly capped the upside, maybe by 20–30%. But fundamentally, these partnerships aren't fleeting trends. They are foundational shifts, firmly positioning this company as the national champion in this critical space.
Beyond those immediate implications, what are some first principles here, and maybe some actionable insights for listeners thinking about this space?
Thinking from first principles. Forget gold, forget oil for a moment. Rare earths, especially high-quality NdPr from a secure deposit like Mountain Pass, are arguably the new geopolitical currency. This company isn't just mining rocks. They're digging up the essential ingredients for the future of technology and national security. Those 15+ years of reserves, that's a strategic asset, not just a commodity number on a page.
Any way for investors to get an edge? Asymmetric information.
One thing to watch closely. NdPr inventories reported in their quarterly filings. A significant dip in those inventories often signals a surge in underlying demand before it fully shows up in prices. That could be an early indicator.
You had an interesting analogy earlier.
The physical Bitcoin analogy, I find it compelling. Rare earths, being finite and critical, act somewhat like a physical store of value, inherently inflation-resistant. You could even consider holding this company's stock alongside Bitcoin in a diversified portfolio, as both potentially hedge against fiat currency debasement, albeit in very different ways.
What are the key risks investors should monitor? The known unknowns.
Project delays are number one. Permitting for the Texas expansion, construction timelines. If things slip by 6–12 months, that could hit revenue projections by 10–15%. Number two is China retaliation. Could they flood the market with cheaper material, dropping prices 40%? It's possible. Mitigation. Those deal floors and offtakes we discussed buffer 50–70% of their output from that risk.
And the unknown unknowns, black swans.
Key uncertainties. Well, a major geopolitical black swan. Maybe an unexpected U.S.-China thaw that dramatically eases tensions and reduces the urgency for domestic supply. Low probability, I'd say 10–20%, but possible. Or a radical breakthrough in recycling tech from a competitor that suddenly commoditizes magnets. Disruptive. But remember, this company is currently leading that charge via its Apple partnership.
Specific things for investors to track.
Definitely track progress on the Maiden JV. That potential Saudi partnership could offer geographic diversification and maybe add 20% to their output down the line. Watch the Q2 earnings call on August 7th very closely for clues about the magnet facility ramp-up progress. A significant beat on NdPr volumes or positive updates on Texas could spark another 20% stock pop.
Any final provocative thoughts?
Just this. Consider the possibility, however remote, that this company, with its mining roots and focus on hard assets, might one day add Bitcoin to its corporate treasury, similar to MicroStrategy. Given the sometimes correlated volatility between critical materials and crypto, it's a move that could potentially amplify upside, or at least signal a very forward-thinking treasury strategy. Something to ponder.
The landscape of critical materials is clearly shifting, rapidly, and this company stands right at the forefront of America's push for strategic independence. We've explored the immense potential, the challenges, and the truly unique position it holds.
Stay vigilant. Continue your own exploration of these insights, and always remember, truly understanding these foundational shifts happening in our economy. The understanding can yield significant advantages for you.
Until next time, keep digging for those insights, because true understanding is always your most powerful asset.
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.